Hi guys, back to my channel. This is Tarun, Air 11 in both C and CMA. So our today's topic is the capital gains. It is one of the important concept in the heads of income, which almost covers 6 to 7 marks out of 35 marks in the taxation paper. So first of all, what is the meaning of the capital gain? Capital gain is a gain arising from the sale of capital asset. That is the transfer of the capital asset. So what is the capital asset? In capital asset, every assets are included as a capital asset, but some of those are excluded from this definition as per our Income Tax Act. So, first of all, stock in trade is not included in the stock capital asset because if you observe business activity, any business purchased in the ordinary course of the business, it will come under the stock in trade or closing stock. So, you may observe from this is a stock in trade asset, but not a capital asset. But when a business purchases the PPE or any kind of the machinery, then it will come under the capital asset. Okay. And personal movable assets. You may observe every day that the personal movable assets like television, we may use the television, car, bike. These are the movable assets which are used for the personal purpose. Personal movable assets are the depreciable assets. So it is not an capital asset. Depreciable asset is not come under the capital asset. Okay. And also some of the appreciable assets in our personal assets, right? And like ring, gold, jewelry, archaeology collections. Uh, you may observe that we may collect the uh, old coins, 25 paisa coins and 2000 rupees notes. These are the archaeological collections which are very old in nature, historical in nature. And drawings, paintings, you may observe the recently Mona Lisa paintings is one of the costliest painting until now. So these are the appreciable assets. So which is so it is come under the capital asset. And sculptures, paintings, any art, any work art. Okay. And another one is the rural agriculture land. You make a note that rural agriculture land only in India is only not a capital asset. But when a agriculture land located outside India, it will come under the capital asset. You should note it. You should note that only the agriculture land in India only. That too, it is a located in the rural areas. So how we decide whether it is a rural area or urban area? From based upon the population of 2011 census and based upon the city, we will decide whether it is a rural agriculture land or urban agriculture land. If the population of a city is less than 10,000, then entire area of that village or the city is covered under the rural agriculture land. Okay. And from population of the 10,000 to 1 lakh, up to 2 kilometers is only rural agriculture land because those areas will covered as a agriculture land, and greater than 2 kilometers it will be treated as a urban agriculture land. And from a population of 1 lakh to 10 lakh, up to 6 kilometers is a rural agriculture land, and population of greater than 10 lakhs up to 8 kilometers is a rural agriculture land. And greater than these kilometers, all of the area will come under the urban agriculture land. From this only you will know whether it is a urban agriculture land or a rural agriculture land. And let's see what is the definition of the transfer. We covered the capital asset definition, and now see the transfer means. What is the transfer? Any sale, exchange, or relinquishment of the asset. Relinquishment of asset means if you are giving the asset to your son-in-law for the giving for the purpose of marriage of your daughter. Okay, this will be the relinquishment of the asset. This also including the transfer and compulsory acquisition of the asset. For example, if a road is extended to four-way, then all the buildings or the assets which are beside the road will compulsory acquired by the government. So this also including in the transfer and conversion of a capital asset into stock in trade. For example, if you have a car and then you convert into the business, that is you may sell a car. You entered into a car business by transferring your own vehicle into the business purpose vehicle. This is also including in the transfer. And maturity and redemption of the zero coupon bonds is also deemed to be a transfer. Like what is the zero coupon bond? If any company issue the zero coupon bond, it will collect the amount which is less than the face value and redeem more than the face value, like redeem at premium, issue at discount. Zero coupon bond. There is no coupon on that bond. That is there is no interest on that bond. There is some of the transactions which is not deemed to be a transfer, like distribution of the capital asset and partition of HUF. If the HUF is part if the HUF are if the HUF are partitioned, then asset will go to their family head and their family people. So this is also not included in the transfer. And any asset uh, and any gift or will or any asset given by way of will. Some of the people will give the asset to the charitable trust upon the will. So this will also is not including in the transfer. Any asset given by a holding company to it 100% subsidiary company and vice versa. If the subsidiary company is also given any asset to holding company, their holding company, then it will not a transfer. And some of the other points is also including in the exceptions of the transfer, which is not much that important. Now we will see what is the types of the capital assets, either the short-term capital asset or long-term capital asset. From this, we can divide based upon the holding period of the asset. If a zero coupon bond and unit trust of India, UTI means Unit Trust of India, which is an organization which have the surplus of funds from all the which have the surplus of funds and give it to the any government and any government body that to RBI or any of the entity. And units of equity oriented fund, which is a which is acts like a mutual fund. Their entire assets are invested on a shares of the company. From there only they generate higher amount of the returns. And listed shares, you may know the shares which are listed in the Bombay Stock Exchange, BSE or NSE. For these, if the holding period is less than or equal to 12 months, then it will be come under the short term capital asset. If the holding period is greater than 12 months, it is come under long term capital asset. And land or building are unlisted shares. These, if you hold these for less than 24 months, less than or equal to 24 months, then it is a short term capital asset. If you hold more than 24 months, then it will be a long term capital asset. Others like jewelry, arts, and any kind of the assets, that is the sale of a business, which will come under the this category. And unlisted securities other than the shares, here listed shares are covered and unlisted shares are covered, but the unlisted securities other than the shares like debentures and preference shares, these will come under this category. If it is hold less than or equal to 36 months, then it is come under short term capital gain. If you hold greater than 36 months, it is a long term capital gain. The main intention of dividing the assets to short term and capital long term is, for the short term capital asset there will be more taxation, and for the long term capital asset less taxation and more benefits than compared to short term capital asset. Okay. And recent amendments on 23rd July 2024 is the recent amendments as per the latest budget on 23rd July 2024, which is the entire period of 36 months is eliminated, and remaining all other the assets are classified into 12 months or 24 months. Like if this is come under the 12 months only, but both of these will come under 24 months. Okay. And one of the important note is market linked debentures. These are the which means this is debentures issued by a company and written based upon the underlying asset. That is the what is the return on a market capital, what is the return on a market index, that is the return from the NSE or BSE. These are underlying assets. Okay. And specific mutual funds, these are always come under a short term capital asset irrespective of their holding period. This will be the important note under the division of the short term and long term capital asset. And one of the focus area on the capital gain is taxes on short term capital gain and taxes on the long term capital gain. First, let's see the what are the tax rates on short term capital gain. If we sold the equity shares or units of the equity oriented fund, and one of the note is STT has to be paid on this. STT means the security transaction tax, which will imposed by the SEBI on sale of the securities, or either the shares listed on the IFSC. IFSC means International Financial Service Center. In India, there will be one IFSC, that is the Gift City located in the Gujarat. If these assets are sold, charge under section 1111A at the rate of 15%, and new amendment for May 2025 is rate has increased to 20% from 15%, because if anyone have the capital gain which is taxable under the short term, then they will have to pay for 20%. So government encourage the holding period of long term. So if anyone hold asset for a long term, then they will have the less taxation. Any assets other than these two taxable as normal slab rates. And what is the tax on the long term capital gain? If it is the sale of the equity shares or equity oriented fund, it will taxable under the 112A at the rate of the 10%. Only if the capital gain on the sale of that asset exceeds the 1 lakh. Okay. And STT has to be paid at the time of the purchase and at the time of the sale also, in this case, in the long term capital asset, in the long term capital gain. Our shares are listed on the IFSC. And one of the amendment for the May 2025 is rate is increased to 12.5%, and also limit is also increased to 1,25,000. This will applicable only from 2025 onwards. And if any assets not covered in the 112A, that is the equity oriented fund and equity shares, then it will taxable under 112 at the rate of the 20%. If a person is a non-resident, then he have a option that he may pay the tax at the rate of 10% on the long term capital gain without indexation benefit, or also he may pay at the rate of 20% with indexation benefit. And recent amendment for May 2025 is on, especially on the long term asset, is they reduce the rate of the tax from 20% to 12.5%. And in the recent budget, indexation benefit is applicable only for the assets acquired on or before the 23rd July 2024. And it is a drastic change, which indexation benefit is not applicable for the assets acquired after this date. And so many of them are confused with the indexation benefit, whether it will whether for which one we will take, either for the 112A or 112. So indexation benefit is only applicable for the 112 section only, but not for a assets covered under 112A. That is the equity shares. Those are the equity shares and units of the equity oriented fund. So one of the important, the concept how to present the capital gain question. Like if it is for the short term, first the full value of the consideration upon the sale, which is covered under the section 50C of the act. And any expenditure on such transfer should be reduced, like any brokerage charges, like and net consideration. From that we reduce the cost of the acquisition, the cost of improvement after the purchase of the asset. If any improvement has been made to that asset, then it is also cost for our, it will also a cost for us. So we will reduce that cost of improvement from the sale value. And finally gross short term capital gain will come. From that we will reduce the any deductions under section 54B and 54D. This will covered in the part 3 of the capital gains chapter. And finally we get the short term capital gain. From this only tax rate under 111A is applicable, that is the 15% for Jan 2025 and 20% for May 2025 onwards. And manner of computation of the long term capital gain. First, what full value of consideration, and from such we reduce any brokerage charges. And here we get the another additional point, that is indexation cost of acquisition. That is because of the inflation, assets will increase by year or decade or from the decade. In the long term capital gain, another topic is to be included, that is the indexation benefit. So what is the indexation benefit? Because of the inflation, asset cost will increase from day by day. So if you purchase the asset on 2009, on that day the cost is only 10,000 or 1 lakh. Max to max 1 lakh is the based upon your land. Uh, if you sell that asset today, it will almost cost to 25 lakhs, or some places cost will increase to, in some places cost will increase to 1 crore, that much. So if you reduce the only 1 lakh from that 1 crore, so capital gain will increase now. So in that situation we reduce the indexed cost of acquisition. So let's discuss within this only what is the indexed cost of acquisition and what is the indexed cost of improvement, and some of the deductions which will cover in the part 3 of the video, that is section 54, 54EC, 54F. And you should note that the security transaction tax is not allowed as deduction in the brokerage charges or the expenditure incurred on such transfer. Okay, and first of all, how to compute the indexed cost of acquisition? If the assets acquired on or before the 1/4/2001, of the formula for indexed cost of acquisition is the higher of the cost of acquisition. That if you acquired the asset before 1/4/2001, the how much cost you how much cost is incurred on that day, or fair market value as on 1/4/2001. But that fair market value does not exceed the stamp duty value as on 1/4/2001. Divided by the cost of inflation index as on 2001, that is the 100, and into cost of inflation index in the year of the sale. You may find this cost of inflation index numbers in my description of the video. If the asset acquired on or after the 1/4/2001, then computation of the indexed cost of acquisition is cost of acquisition divided by the CIA on the year of the acquisition and into CIA in the year of the sale. And also how to compute the indexed cost of improvement. If you done any improvement, that is if you constructed a building on the land that you acquired, this will also a this will also a cost of improvement. So for this also you will get the benefit of indexation. So here, what is the cost of improvement divided by the CII on the acquisition into CII on the year of the sale. So from this you will get the indexed cost of improvement. And so if any asset acquired on or before 1/4/2001, cost of improvement is already included in the fair market value of that asset. So there is no need to compute the cost of improvement on separately. Let's see the what is the cost of acquisition on each scenario. If you have a goodwill on the asset, like that is a self generated only, then cost of acquisition will be nil. If it is acquired or purchased, then cost of acquisition is the purchase price minus depreciation if any. If the asset acquired as a gift or if the asset acquired by way of a gift, then cost of acquisition is the purchase price of the previous owner. If you have a gift, if you get a gift from your grandmother or granddaughter, like any ring, if what is the purchase price to them, it will be the cost of acquisition on the date of the sale. And if the equity shares are equity oriented fund, that is a mutual funds acquired on or before the 31st January 2018, then we calculate the cost of acquisition on a separate basis, but not on this basis. For these assets, indexed cost of acquisition will not apply, so we calculate the cost of acquisition on a separate manner. That is, the cost of acquisition is the higher of actual cost of acquisition. What is the price you purchase for that shares? What is the price of the share when you purchase it? And B is the lower of the fair market value of the share as on 31/1/2018. If how to compute the fair market value of that share as on 31/1/2018 is the highest trading price of that share in the stock market. That is the if the share price is the highest share price is as on 31/1/2018 is 500. If the lowest value is the 480, then you take the 500 is the fair market value. That is the highest traded value of the share, and share value of sale value of the shares as on the actual sale value of the share. If you want to get a little bit clarity upon this concept, then refer first question in the test of your knowledge in the ICA textbook. And the same manner we compute the what is the cost of acquisition for the bonuses. So obviously we will get on a free of cost from the company. Okay, and if the but from this different scenarios, if the bonus is allotted before the 1/4/2001, then the cost of acquisition is the fair market value. What is the fair market value? How we computed the fair market value? Based upon the highest trading price of the share on that day. That is 1/4/2014. And if bonus is allotted by the company from 2004 to 2018, then the cost of acquisition will be the same as computed is the equity shares. Like this will be the cost of acquisition for the bonus shares. Obviously, cost of acquisition will be the nil, and higher here there is a higher now. So we compute the based upon these two values. We compute the cost of acquisition of the bonus shares. And if the bonus is allotted after 2018, then the cost of acquisition will be nil. So entire value of the share when you sell is taxable under capital gain. And in normal days, we observed that so many real estate dealers are sold the assets at less than the fair market value. On the table, they sold at less than the fair market value, but below the table, they exchange the cash more than the actual value, because to reduce the taxation. So for that purpose, government has introduced the section 50C, which is the if any person sell a land or building less than the stamp duty value. The stamp duty value is the government on the basis of that population and the valuation of the land in that particular city. So if you sell the any kind of the land or building less than the stamp duty value, if it is if the difference between the sale value and stamp duty value is greater than 10%, then full value of consideration is taken as a stamp duty value. What is the While computing the capital gain, we consider the full value of the consideration. So it is computed as per the section 50C. And if the difference between the sale value and stamp duty value is less than the 10%, less than or equal to 10%, then full value of consideration is the actual sale value. So government will allow up to 10% discount on the on the stamp duty value. After the discount of 10%, it will automatically consider the value of consideration is as a stamp duty value. And how to calculate the difference? Stamp duty value minus sale value divided by the sale value into 100. So many of them confused with the which stamp duty value has to be considered, either on the agreement date or on the sale date. If there is agreement between the buyer and seller, and that too any advance received in the in the mode other than the cash, bearer check, cross check. Bearer check, cross check is the checks you only enter the any amount on the check and take the amount from the banker. Okay. If you received any advance other than these modes, then stamp duty value to be considered as an agreement date. If you if the advance is taken by any of the cash or bearer check, cross check, then stamp duty value to be considered as on the sale date. And another topic is the forfeiture of the advance. This is also an important topic which will mostly touched by the ICI and IFOS. If you forfeit the advance on or before 1/4/2014, then the advance will reduce it from the cost of acquisition. See, most of them will do the mistake while reducing this forfeiture amount. You reduce the forfeiture amount after the computing of higher of the cost of acquisition of fair market value, or higher of the uh, or cost of acquisition here cost of acquisition minus forfeiture amount. Here the forfeited amount is taxable on the date of the sale. That is, forfeited amount is postponed to the sale date. And if the amount forfeited after the 1/4/2014, that amount is taxable under the head income from other sources. That is, capital gain is taxable at the year when you forfeit the amount. Taxation will not be postponed in this case. Thank you. You may download this you may download this copy from the description of the video, and if you have any doubts on this topic, please feel free to comment on the video. We'll respond based upon your doubts and follow up of your doubts. Thank you. Like, share, subscribe my channel.